Hello, beautiful people, and welcome to another brand new episode of the ITU Forex Class. In this week's episode, we're actually going to be talking about indicator mistakes that kill trading accounts. Okay, so basically, we're going to be talking about the most of the rookie mistakes that traders who are inexperienced in trading or traders who are yet to become profitable traders usually tend to make, so that you'd avoid them like the plague and do what the traders who know what they're doing, the professional traders who are able to do this for a living are able to do, and so that you can become profitable. Okay, so first things first, what are indicators? Because before we even talk about mistakes that indicator mistakes that cause people to blow their trading accounts, you first need to even understand what an indicator is in the first place, right? So basically, indicators, or technical indicators as they are also called, are basically just mathematical calculations which uses the price of a tradable instrument to compute some set of data or formula to help you analyze price in a way that would make sense, or in a way that would help you to speculate when price is likely to go up or down, and all of the things like that. Okay, so to give you a very simple example, what you're seeing on my chart right now, the red and blue lines, they're also known as technical indicators. In fact, they're one of the most popular technical indicators in the trading industry. They're called moving averages. Okay, so the reason why I said they're one of the most popular is because actually a lot of traders tend to use them to identify trending market conditions, to take advantage of those trending market conditions. Because when we are trading, we want to, especially in the forex markets, you want to buy an instrument when its price is relatively low, so that when it increases in value, you close your long position and bank the profits you made from the trade. And when a particular instrument is moving down in the forex market, you can sell, because in the stock market it's kind of complicated, but in forex you can go long and you can go short. Okay, so in the forex market, if you, through your analysis, you've identified that the particular instrument you're analyzing is going to go down, and you decided you want to short that trading instrument, the idea is to short it when it's expensive, or to sell it when it's expensive, so that when it decreases in value, you can cover your short, as it is called in forex, and then you'd bank your profits from that trade. Okay, now what does this have to do with technical indicators? What does this have to do with moving averages in particular? Okay, remember I told you that technical indicators are basically formulas, mathematical formulas, that uses price input of an instrument on the chart to compute some numbers that would help you maybe plot a line, or draw some instruments, or print some labels on the chart, which would help you to identify low risk, high probability trading opportunities. In this case, for the moving average indicator, the way it is being calculated is usually it's going to take the reading of the candles on the chart, depending on the time frame that you're on, and it's going to compute those candles based on the inputs that was added to the indicator, that was entered into the indicator's dialog box when it was being added to the chart, and then it's going to plot a line on the chart. So going back to the basics, this red line that you're seeing is a 200 period moving average. Now, since we are on the 1 hour chart, basically what this period is telling you is that you're going to go back 200 candles on this chart. Okay, so the last 200 candles on this chart, since this is a simple moving average, okay, and we're applying it to the closing price, all this indicator is doing is it's taking the closing price of this candle, and then it's taking the closing price of this candle, this candle, this candle, this candle, all the way to the 200th candle at the back, and then it is adding all of those closing prices of all of those candles, and it's dividing that number, the resulting number of the summation that it's doing, by 200, because that's the period we have here. And so the number that it gets is going to be a price number on the axis of the price chart. Okay, and so it will just add a dotted line, and then it will connect it to the previous line. And so the reason why it is called a moving average, because if it was just a simple regular average of anything, you just get your number, the average number, and that's it. You've done your calculations. But in the trading industry, the reason why they are called moving averages is because once the calculation has been automatically done by your trading platform, and bear in mind that the traders who came before us, the ones that were trading way back in the day, they didn't have these powerful computing tools that we have today. And so they had to do these calculations manually and plot these lines by hand, using the price feeds that they get from the newspaper and all of that. And they'll plot these charts by hand and they'll trade like that. We have trading platforms that just do these things for us automatically. We don't even have to lift a finger. After you've added the indicator on your chart, it's going to do it for you automatically and just plot the lines. Okay, so moving on. If this was just a regular average, like the average of the average scores of students in a certain class who took a certain test, for example, then we're just going to get the average number and that's it. But in the trading industry, because as time goes by, new information keeps getting into the market. There's a new high price, a new low price for that particular time period that you're analyzing. There's a new closing price and all of those opening price and all of those data. Then, since there are going to be new candles being formed, new information is going to be taken and used to calculate new average prices. And so, when those new prices are calculated, when they get printed or plotted on the chart, the trading platform is automatically going to be connecting them with a line. Okay, and as new information, new price gets into the market, new averages are going to keep formed and they are going to keep getting plotted with in the trading platform. And that's why it's called a moving average, because as new price information comes in, it's going to get calculated and it's going to keep moving and calculating the averages over and over and over again. Okay, so basically this is just one out of the countless technical indicators that we have in the markets. When you go to the indicators tab, when you're using your trading platform, this is MetaTrader 4. But when you go to the navigations tab and you hover your mouse's cursor over that indicators tab, you would see a ton of technical indicators. There are custom indicators, there are regular indicators. You'd find lots of them over there. Okay, so basically, now that we've gotten the definition of indicators out of the way, let me give you an example. You see, there's a simple trading strategy that lots of traders use profitably to trade the market. Okay, and one of those strategies is the moving average crossover technique. So the idea here is that two moving averages are going to get plotted on the chart. One moving average is going to be a slow moving average. In this case, our slow moving average is this red line, which is plotting our 200 period moving average. Remember, all that 200 is telling you, that 200 period is that it's taking the reading, the closing price reading of the last 200 candles, and it is using them to calculate the data for this particular indicator, which is plotted by this red line on the chart. While this other blue line is the fast moving average for this particular situation, and it is a fast moving average because it's a 50 period moving average. And so all that means is that it's taking the reading of the past 50 candles. When I double click on it here, you can see that it's 50 period moving average, it's a simple moving average, and it's applied to the closing price. So basically what it does is it takes the closing price of the past 50 candles and it adds them together and divides them by 50. And so it keeps, when new information comes into the market, it calculates another average and it keeps plotting them and connecting them with a line. This is like the blue line you're seeing here on the chart, okay, on the screen. So the simple trading strategy I told you about is, like I said, a moving average crossover technique, moving average crossover strategy. So basically what it means is that the way it works, not what it means, but the way it works is that traders would wait for the fast moving average to either cross above or below the slow moving average, and then they will take a trade in the direction of the trend. So if the moving average, the fast one, you can see here, it crossed above the red moving average, the slow moving average. In this case, this would have been a signal to go long on this currency pair. Okay, and then you can see it crossed below this red line. In this case, this would have been an indication to go short. This is just an example that I'm showing you. It's not like I'm telling you this is the best trading strategy out there or whatever. No, this is just to give you an example. Okay, now the thing is, most traders assume that if a technical indicator this we're using the example of moving average for this particular situation, but you could swap that with any other technical indicator, stochastics, oscillators, or Fibonacci, or anything at all. Okay, so some traders, especially traders who don't know any better or who don't really understand what the role that probabilities plays in the game of trading, they would assume that whenever, especially if they learn a trading strategy and as soon as they go into the markets to trade with that trading strategy, they encounter winning trades. Okay, for those type of traders especially, you'd notice that whenever they use a particular trading strategy and they identify a trade setup based on the use of some tools or technical indicators that tell them when to buy or when to sell, usually they feel that the indicator telling them when to buy or when to sell is absolute. So without knowing that these indicators don't just plot themselves, the indicators actually use the price data that is printed on the charts to calculate whatever information they are going to present to you. So whatever indicator you're using is actually going to be lagging behind price, because using the example of the moving average that we just talked about here, the indicator is not going to plot anything unless the candle has closed, if you're using the closing price or applied to the closing price to calculate your moving averages. So if the candle doesn't close, it's not going to get the closing price that it's going to use to calculate those average, the moving average for you in this case. Okay, so moving on. Now, assuming you were one of those traders who just learns a trading strategy and maybe you don't know any better, you would think that whenever you see the blue moving average crossing above the red one, which in this case is the fast one crossing above the slow one, that's a buy signal. And so if, for example, you just took a couple of winning trades with it, you would assume that whenever this happens, you're absolutely going to get a winning trade because the indicator said price is going up. But that's not the way it works. An indicator, a technical indicator in this case, is just giving us kind of like a probability of one thing happening over another. So let me explain what I mean. Technically, when for this particular trading strategy, when this blue indicator crosses above the red one, it is telling you that, okay, there's a high chance that price is likely going to move up because the fast moving average has crossed above the slow one. But this is not a certain thing. There's no certainty here. And that's why risk management is always important. I want you to notice the theme across these ITU Forex classes. We'll talk about technical concepts or psychological concepts or any of those concepts. And we keep cycling back to risk management. And the reason is because risk management is one of the core concepts, one of the core pillars of trading that no matter how good a trading methodology you're using is, if you don't couple it with risk management, it's almost always not going to work. It might work for some time, but then you'd get greedy or you'd get fearful or you do some risk management blunder or make some risk management cardinal sin or big mistake, which will eventually cause you to not be able to make money, okay, in the long run. And so whenever you're trading with any trading methodology, even if the technical indicator gives you a signal that, okay, price is going to, you should buy this particular instrument because price is going up, always know at the back of your mind that technical tools are only telling you that there's a probability that price is likely going to do one thing over the other. And it's not a certainty, 100% certainty that price is going to do that thing. And that's the reason why we do proper risk management, so that when it doesn't work, our losses are going to be very small. And for the times when it does work, we want to make it in such a way that our profits will be very big, so that they will not only pay back the losses that we incurred when we encountered losing trades, but they will give us extra profits in the process. So looking at this example, assuming we decided that, okay, we are trading with this trading strategy. Remember, I told you that when the fast moving average crosses either above or below the slow one, we take a trade in the direction of that crossover. So in this case, this blue moving average crossed below the red one, which is the slow one. So this would have been a sell trading signal. And let's say we only close our trade setup when the opposite signal occurs. So let's say you took a short trade here, and when the crossover happened here, you would have closed this short. But pay attention here, because when this crossover happened, it was somewhere around here, and at the close of the candle, you would have bought somewhere around here. Sorry, you'd have gone short or sold somewhere around here. This is when the crossover was validated, okay? So if you had sold here, and then you didn't close the trade because we didn't get another crossover until it happened somewhere around here, then you would have closed the trade here with a little bit of loss, which is normal because some traders would, especially new traders, they would see that, okay, this trading strategy just gave us a losing trade. I'm not going to use it. That's not how trading works. No matter which trading strategy you're using, you're going to encounter losses. You just need to play the game properly, do proper risk management, and so eventually, even if you encounter those losing trades, which you are inevitably going to encounter, they're going to be managed, because your winning trades hopefully are going to be big enough to make up for the losses and give you extra profits in the process. Okay, so assuming you close the trade here, you would have closed with a little loss and you would have opened a long trade because this is where the crossover happened. But then after you would have taken the long trade somewhere around here, the same thing happened. We had another crossover here, so you would have closed the long trade here when when another short crossover happened here with a small loss. And then another crossover happened here, which you would have closed this trade you took here again and opened a long trade with another small loss. But pay attention to what happened. You would have had a loss here, small loss here, small loss here, small loss here. But then you would have gone long when this crossover happened here. And just look at the immense amount of profits you would have made, because this trade would not have been closed up until the moment when this crossover happened, which is somewhere around here. So you'd have made over 200 pips. And what did you lose here? Cumulatively, maybe the loss you had when this whipsaws were happening here, this ranging market conditions, total, maybe you would have lost like 60 pips, for example. If you're doing proper risk management and maybe risking 1% of your trading account capital, you would have made enough profits to cover all of the losses that you would have encountered somewhere around here. And if we even go way back, look at how a very huge profitable trade that you would have caught here using the strategy. We had a crossover here, somewhere around here. You would have taken a short trade. And look, this one would have given you even more than 200 pips in profit. Okay? So the thing is, traders who are just getting started, they would see, especially when they attend classes like this, they would see big winning trades like this, and it would entice them to use trading strategies like the one I just explained to you here. But the truth of the matter is, when they encounter losses, when the market is struggling to move in one direction, just like you have here and all of those losses, usually these traders will not be patient enough to know that this is part of the game, and they just need to firm it and stick to the rules and just keep doing what they do, so that when the trend does eventually come, they would make back for their losses. And so when they take 1 or 2 or 3 losses in a row, they would just abandon that trading strategy, and they would miss out on the chance to catch big winning trades like this, which will make back for those losses. So in a nutshell, the biggest mistakes that traders make with technical indicators is that they assume that when the technical indicators gives them a trading signal, that signal is absolute. Like when the indicator tells them to buy, the price of the instrument that they are trading has no other option than to go up. And that couldn't be further from the truth. When a technical indicator gives you a long trading signal or a long trade telling you that the instrument you're trading, for example, or you have the indicator on the chart of that particular instrument is going to go up, it's kind of like an educated guess that the indicator is telling you that, okay, it looks like, based on past price data and how this instrument has been moving and all of those things, when it gives you a long trade signal, it's basically telling you that there's a high likelihood that this particular instrument that you're analyzing or you're trading is likely going to go up. Is this 100% certain that it's going to go up? Obviously, that's a no. That's not the answer. And so because of this, you need to couple whatever trading technique or tool or whatever indicators you're using with proper risk management, so that for the times when it gives you a trading signal that doesn't work out, your losses are going to be limited. And then when it does give you trading signals that do work out, your profits are going to be so huge that they will pay back for those small losses that you encountered when it gave you signals that didn't work out, and give you extra profits in the process, so that you'd be able to make profits from trading. That's just the way it works. Okay, so what I want you to take away from this lesson is the fact that when a technical indicator gives you a signal that price is going to go up or price is going to go down, take that as a suggestion and not as a concrete yes or no that price is going to do this thing. And since the indicator has said it, nothing else other than what the indicator said is going to happen. So if the indicator made a crossover telling you that price is going to go up, then price has no option than to go up. That's not how it works. That's just kind of like giving you a hint that price, there's a probability, higher probability, maybe a 55% probability that price is going to go up as opposed to it going down. But remember, there's still a 45% probability that price could go down. And so that's why you want to manage your risk properly. Okay? So this pretty much brings us to the end of this week's edition of the ITU Forex class. I don't want to keep this overextended. And so before we wrap up the class, I would like to use this opportunity to invite you guys to test out our ITU suite of bots or expert advisors, which are basically tools that are designed to look for low risk, high probability trading opportunities on your behalf on autopilot while you're out there doing whatever you want to do with your time, or maybe even sleeping. And so they will look for those low risk, high probability trade setups automatically for you. And if you follow our risk recommendations and set everything up, they're going to take those trades for you with proper risk management and get you to start earning while you're learning how to trade. Okay, so if you're interested, please reach out to us on any one of our social handles or drop a comment in the comment section, and would be more than happy to assist you set everything up and lead you to how to set everything up in a step-by-step manner. Okay, in the meantime, I sincerely appreciate you guys taking time out of your busy schedules to attend these classes, and I look forward to seeing you guys in next week's edition of the class. Once again, have a wonderful rest of your week, and God bless you all. Cheers.